Important lessons before getting into trading strategies. Volume price analysis. We will cover this topic in detail with examples, as this concept builds one of the fundamental skill sets needed to really understand charts and price movement. We covered volume briefly in the earlier section, but that was just the base definition. This section would explain how you can really read the volume behind price movements to gauge if the price movement is real or manipulated. If I could sum up everything volume price analysis has to say, it would be this. If the price movement is not corroborated with volume, then there could be many reasons for the same, including manipulation by the big players. But if there is volume to support that movement, then there is good reason to believe that the price movement is real. Understanding of this very concept can significantly improve your trading skills, and this knowledge is applicable irrespective of what trading strategy you deploy. This concept was put forth by Charles Dow, who is considered the grandfather of technical analysis. One of the best books on volume price analysis that I would really recommend is A Complete Guide to Volume Price Analysis by Anna Culling. The big players. I don't want to spend much time on the literature behind this. Those of you who want to explore this in more detail can read The Wall Street Jungle by Richard Ney. Other books from the author that build on this theme include The Wall Street Gang and Making It in the Market. The essence is that there are so-called insiders, institutional investors, market makers, hedge funds, etc. Basically the big players or the big gang who have access to special information and the power to profit from all sorts of transactions. They can use various tactics to lure normal traders and investors into buying or selling. One of the most common tactics is using news or mass media. One can spread greed, fear, or panic via these media stories. But we do need market makers to ensure liquidity. In other words, to make sure that your order to buy or sell goes through without a hitch. When you wanted to sell shares, you do not even bother if there is someone on the other side to buy at that price. Isn't it? Your trade just goes through. Market makers have to honor the trades on both buy and sell sides, and they in turn manage the order books. They can see both sides of the auction and are licensed to operate by the government. Anyways, we are not here to cry about it. We are here to understand this and ride the wave with them. Rather than being stuck on the opposite side, we don't want to fight them, or let's say we cannot fight them. But we can sure be smart enough to understand when they are about to make the move. That is where volume comes in. Price can be manipulated. Even the volume can be hidden sometimes. For instance, some of the block trades are hidden from us till they are actually executed, or some are reported in after hours of trading. Not even level 2 data covers them, but volume is still the best tool to see what is at play. The classic Big Brother's play. Imagine for a few minutes that you are one of the big players. Feels good. What do you want to do? Make more money. Simple. So, you want to buy a stock at a price and then sell it higher. Simple. Not for you. You are a big guy, remember. You operate in large volumes to make big money. If you start buying it all in one go, prices will shoot up quickly before you have bought enough, as everyone will see you making a move. You have to be smart, discreet. So, you buy slowly. You accumulate shares over a period of time. This is the accumulation phase. But how do you make sure that the retail traders sell you all the inventory you want to accumulate? They use mass media. News of massive sell-off, bear market, poor economy, etc., etc. As you start buying within manageable volumes, the prices move up a little. Some retail folks who were still holding on are relieved that the prices may go up again. But shortly after, the prices are dropped and more retail traders are shaken out to sell. You repeat this over and over again till you have bought enough. The emotion in retail traders here is of fear and panic to avoid or minimize losses. Now you have bought enough. It's time to raise the prices and sell higher. Again, it cannot be done too fast, else you will not have enough buyers. This is the distribution phase. The emotion to be triggered here is that of FOMO, fear of missing out, and greed. You give the stock price a little push. Regular, mortal folks see the movement and take notice. Media comes into play to talk about good stories, economy reviving, political and regulatory environment is great, and so on. Retail traders start to fear that if they don't take it now, prices may be too high tomorrow. FOMO, FOMO, and more FOMO. The crowd starts to join the party. The big brother keeps moving the price up, inviting more and more to join. The move up is slow with small pullbacks. No one wants to miss this awesome ride. After a while, the momentum kicks in, and the prices rise faster. Some folks who are still sitting on the fence, waiting for the confirmation, now join the party as well. And all this while, you, the big brother, is happily selling to retail traders who are hungry to take it at any price, as the price keeps moving up. Once the prices have reached the desired levels, you continue to sell manageable volumes within a smaller range. With every small dip in that range, they invite few more buyers. Once the big brother has sold all the inventory, they drop the price slow and steady with pullbacks. Then the price starts to move down faster, and panic ensues. Retail traders sell, sell, sell. Those traders who bought early on want to make sure that their profits don't turn to zero. And the ones who bought at the higher price fear for the higher losses and want to minimize further bleeding. And the big brother is now buying at a lower price. This whole cycle of accumulation and distribution repeats itself over and over again. You can see this across various time frames. The more time is spent in consolidation, the higher the possible move. I will mention the part volume plays in each of the trading strategies we discuss, but I still want to cover some basic principles here, so that you have a stronger grip on the concepts before we get into trading strategies. Like I mentioned, if the price movement is not corroborated with volume, then there could be many reasons for the same, including manipulation by the big players. But if there is volume to support that movement, then there is good reason to believe that the price movement is real. Let's see what this means. Imagine you are manually pushing a heavy cart. You would need more energy when the cart must be moved faster. But maintaining a steady, slow pace may not need significant burst of energy. The same is true with price charts and corresponding volume. Volume is the energy, and price is the cart that has to be moved. If you see a strong uptrend with rising volume, you know that there is real energy behind the move, and there is higher chance of that trend being real. If on the other hand the price is moving fast but volume is low, you can assume there is something fishy. Look at the chart here. The chart here is a basic depiction with single price candles. Let's see the first one. There is significant price movement shown by the candle spread, but volume is low. The volume, which is the energy, does not support the movement of our cart. Let's see the next one. Here, the price movement is confirmed with a higher volume. Look at the third one. This is again an anomaly as the volume is high, but price movement is low. Now, on to the last one. Here the price and volume are in sync. Now let's see this on an uptrend with multiple price candles. Here you see rising volume with larger candles. That confirms the uptrend. In this second one, we have larger price movements, but at reducing volume. That doesn't look right. Now, let's see the chart of a downtrend with and without volume confirmation. Here, rising volume with larger candles confirms downtrend. And here we have larger spread candles without proportional volume jump. That doesn't look right. Note that no rule in trading can be a certainty. There would be occasions where a trend with low volume may continue to rise higher. But as I mentioned earlier, we can only talk about the concepts that usually hold. That is, the ones which have a higher probability. Let's get back to our example of a heavy cart. Now imagine that the cart is moving at high speed, and now you suddenly have to stop it, or even reverse its direction. This will again need a lot of energy. This is what is needed for reversals in price charts. The stopping energy is called stopping volume for stopping the downtrend and topping volume for stopping the uptrend. Here is the chart with a single reversal candle. That can be a doji, indecision, hammer, shooting star, etc. For reversal or indecision candles, higher volume is an indication of higher chance of reversal or pullback, as is shown in B and D. Refer to the chart here, with multiple candles. There is a downtrend showing signs of stopping or reversing. The candle spreads are getting narrower, and the lower wicks are prominent. On the left, we have volume confirmation. Rising volume for reversal candles acting as stopping volume, but not so on the right. Here, the price chart is indicating a reversal or a pullback setup, but it is not confirmed by volume. So, we need to be cautious here. Volume does not support the price pattern. This could be a trap. Here is a chart with an uptrend showing signs of stopping or reversing. On the left, we have volume confirmation. We see topping volume, but not so on the right. Note that the price may take a while before it starts to reverse. It may consolidate for a while or present multiple reversal candles, etc. The point is that you should not jump into a trade just because you saw this pattern and the volume confirmation. We will discuss the trading strategies later, where we will talk about the multiple factors we need to take into consideration before getting in a trade. Risk management. I know where I'm getting out before I get in. Bruce Kovner. Don't focus on making money. Focus on protecting what you have. Paul Tudor Jones. We want to perceive ourselves as winners, but successful traders are always focusing on their losses. Peter Borish. I have read this in every book that is out there on sale, and have also learned it myself, having faltered to follow the rules, even after knowing the facts. Success in trading comes from mastering one setup or strategy. That is, knowing when to enter and when to exit. How to minimize losses, and controlling our emotions before entry and during the trade. Often, when traders fail to make money in trading, they blame it on the strategy, and then go out there looking for more advanced indicators and complicated strategies, not realizing that the crux of the problem is not the strategy itself, but our discipline to stick to the rules. We will delve into this topic in more detail in the psychology section, but it's important to cover this in brief as a key pillar to successful trading. One has to realize that no matter how good you are or how confident you are about a particular trade, anything can happen. Usually, what happens is that when you see your trade going wrong, you are hopeful that it will turn around. Or you can't just convince yourself to hit the exit button and realize the loss. Let me just wait for some more time. Maybe it will turn back to break even or even a profitable trade. Sometimes, it's the ego that's calling the shots. I am a good trader. I cannot accept defeat. If I exit now at a loss, that means I am defeated by the market. Let me hold on for a bit longer. As you will learn in later chapters, losing is part of the game. Even if you lose more than 50% of the trades, you can still be profitable overall if you manage your losses and maximize profits. To be consistently profitable, you should be able to calmly accept a loss as an integral part of the overall play. So, my dear friends, have the safety belt on before you start trading. Stop loss comes before the trade. It should not be an afterthought that you may add after entering the trade or choose to ignore altogether. This is one of the most important and simplest things to do. Yet, many traders choose not to follow this, only to see their accounts evaporate after one bad trade. Consider the scenario in the chart here. Let's say I want to go in for a long trade, expecting the price to go up to a certain level. I buy 100 shares of Tesla at a price of $901. So, the capital invested is $90,100. I am expecting to touch $945 based on my strategy or estimates. Expected overall gain of $4,400. The price initially moves in our direction, but soon reverse. I tell myself that it's only a temporary blip and would come back up. I don't need to put a stop loss. But the price falls further. Now I have started to accumulate loss. At point 2, price is at $890. We have lost $1,100. But I am certain that it will go up. This confidence that I have could be a product of a streak of winning trades in the recent past, or a big win recently, or due to my overall high confidence attitude, or just that I am feeling great today. Doesn't matter what the reason is. The point is that I am feeling good, and I am confident about my position, and my stock has to go back up. I am good at what I do. I have done so well so far. I know my stuff. So let me add to my position, and that will help me buy more stocks at a cheaper price, and that will bring down my average entry price. This can help me break even faster if I wish to, or I can continue to hold and see my profits soar. So I had 100 shares at $901, and I take another 200 shares at $876 as I see some signs of reversing. See this table here. Now I have 300 shares at an average price of $265,300 divided by 300, which is $884. But the price falls further, and at point 3, that is at $848, I have total loss of $884 minus $848 times 300, which equals $10,800. I may keep adding to my losing position if I am very certain of my trade. This is called averaging down. You may get away with this a few times, but on that one occasion, when it keeps going against you, one can lose his or her entire account on that single trade. Averaging down is an absolute no. Absolute no. Always, always have a stop loss in place. Some of the classic trader stories have this very concept played out, and the amounts were staggering. These were successful, professional-grade traders, and yet they made that mistake. Overconfidence can lead you to skip some basics, no matter how experienced you are. You should read about them. There are great lessons in these books, not just from how they made that money, but more so on how they lost it all. These books will help you keep yourself grounded and follow the basic principles, no matter what. Lessons from their failures can be a strong reminder for us to stick to the rules. Some of these books are Reminiscences of a Stock Operator by Edwin Lefevre, based on the story of Jesse Livermore. What I Learned Losing $1 Million by Brendan Moynihan. So, going back to the chart we just discussed, I would first have my stop loss placed at price $891 or any other price point based on my strategy, and then initiate the trade of 100 shares at $901. Stop loss is a limit order to be triggered if the price falls below that price. The actual long trade at $901 can be taken as a limit order or market order. So in this case, when the price goes against me, the max I can lose is $901 minus $891 times 100, which is equal to $1,000. And then I am out of that trade. As they say in trading, you need to manage the risk to live another day. Never risk more than what you can handle. You can set rules, like I will risk maximum X dollars on any trade, or X% of my account size. Usually, you should not risk more than 1 to 2% of your account size in a single trade. Some people implement stop loss manually via market orders if they see the price moving above or below the threshold. They keep that stop loss or the loss amount in mind, rather than actually having it on the system as a limit order. I prefer to have the stop loss on the system, either via hotkeys or visual tools. I don't want to test my mental strength to have to take the explicit action when the price is going against me. I would rather have it already placed as a limit order and get executed. Moreover, sometimes the rise or drop is so sharp that you may lose a lot on that slippage if you follow a manual approach. The beauty of probability and risk-to-reward ratio. We can't predict the future with certainty, and interestingly, we don't need to. What matters is your ability to use the information available at every moment to make the most appropriate decision. Ray Dalio. I don't think you can consistently be a winning trader if you're banking on being right more than 50% of the time. You have to figure out how to make money being right only 20 to 30% of the time. Bill Lipschitz. In the next section, we will discuss the building blocks of a trade and then move on to trading strategies. I am sure you are too eager to go to these sections and may even want to skip everything in between. It's too tempting to get into action, but I cannot emphasize this enough. Understanding probability and trading psychology are equally, if not more important than trading strategies. The problem is that traders, far too often, focus only on the strategies and believe that a lack of sound strategy is the root cause of their losing trades or declining account balance. I was debating if I should also cover psychology before I get into strategies, but then I may be testing your patience far too much. We will cover the psychology part in later chapters after going through some strategies. But let's get back to the topic of this section. Probability. This is, in fact, a building block for the psychology section later. But I will try to keep this section focused only on the mathematical part. Let's begin. You will learn a number of strategies in the course of developing as a day trader. You may pick a strategy from this course, or another one from a forum or a friend. But do keep in mind that no matter how simple or complex the strategy is, it will never have guaranteed success. No matter how hard you try to make any strategy as awesome as possible, you will still have losing trades. Let's take a hypothetical example where you have a strategy that has an average win percentage of, say, 55%. Then, you will win 55 trades on an average out of every 100 trades, give or take a few points. And if we take a simple case where your risk-to-reward ratio is 1:1, so you win 55R and lose 45R, making 10R in the process over 100 trades. R is the risk in terms of amount that you are willing to take in a trade. You can just continue to do this day in and day out and make 10R over 100 trades. Now, one may wonder that the winning rate of 55% may vary. What is the guarantee that I will win 55 out of every 100 trades? Here comes the beauty of probability. The win percentage may vary a lot in a given set of trades, especially if the set being analyzed is small. For example, you may end up losing 10 of 10 trades if that is the sample size being analyzed. So, the win rate is 0%. But, when you see the mix over a large number of trades, the average win percentage will approximately hold. Compare this to flipping a coin. We know that the probability of getting head is 0.5. But it may happen that the first 5 flips may all give tails. But when you see the mix over 100, 200, or 1,000 flips, the average will hold closer to 0.5. Now, the next question in your mind may be, why just 55% win rate? Isn't it too low? I have seen online forums abuzz with folks claiming 85%, 95% win rates. Gullible novice traders may fall for these without understanding the basic levers at play. A large percentage of these folks claiming 90% win rates are just trying to lure new traders into buying something from them or build subscribers for their channels. It's a shame, but it's a hard reality. Anyways, I can't change that. So, let's get back to the topic of 55% win rate. The answer to better returns does not rest only with a higher win percentage. You have a powerful tool at your disposal called risk-to-reward ratio. We briefly touched upon it in the introduction of key terms. For example, the risk-to-reward ratio of 1:2 means that when you lose R, but when you win 2R. R is the amount of dollar risk you are willing to take in a trade. So, if you maintain this risk-to-reward ratio of 1:2 or 1:3 or higher, you can afford to have a much lower win rate and still make money. Again, for illustration, let's say our risk-to-reward ratio is 1:2. In this scenario, even if your win rate is as low as 33%, you will roughly break even. Wins equal to 2R times 33 trades, that is 66R. Loss is equal to 1R times 67 trades, That is 67R. And now imagine a strategy with 55% win rates, as we discussed earlier. Your returns will be 65R. Wins equal 2R times 55 trades, which is 110R. And losses equal to 1R times 45 trades, which is 45R. Profit is equal to 110R minus 45R, which is 65R. Did you spot the difference? With a risk-reward ratio from 1:1 to 1:2, keeping the win percentage same at 55%, your profit went up from 10R to 65R over a set of 100 trades. Before we get into strategies, note that most of the strategies have a low win rate of 35% to 60%. Learn to recognize trades with potential for high risk-to-reward ratio, and you will make money even with low win rates. Some traders prefer to enter the trade early with tight stops to maximize the risk-to-reward ratio, but this approach has a low success rate. One of my fellow traders likes to get into the trades early with a very tight stop loss. As a result, he has a low win percentage of 25%, but a high risk-to-reward ratio of 1:5, which works perfect for him. On the contrary, I am personally not comfortable with very low success rates. Traders like me prefer to wait for confirmation before getting into the trade. None of the approaches are good or bad. It just depends on you as an individual and your comfort level. You may refer to the tables here for reference. Assuming that we follow the approach of a fixed risk, R equal to $10 with every trade. The first table indicates the returns over 100 trades with a win rate of 25% and risk-to-reward ratio of 1:5, making 50R over 100 trades. The second table indicates the returns over 100 trades with a success rate of 40% and risk-to-reward ratio of 1:2. This makes 20R over 100 trades. The kind of strategy you pick is very personal. I will cover this later in the psychology section in detail, but just keep in mind that everyone may not be comfortable with just a 25% win rate. Imagine the feeling of losing 75% of the trades you participate in. So, you need to see what you are comfortable with. Initially, feel free to try various strategies. You cannot find an answer just by reading a book, attending a course, or by thinking about your personality. Do not try to rush it. Go ahead and test the strategies in a simulator first, and then with real money, albeit small, till you feel confident. This process of learning, testing, and discovering can take months or years, depending upon your process and time spent in practice. Let me just explain this visually once, as we will use this terminology a lot when we get into strategies. Refer to the chart here. Let's say we are planning to take a short trade based on our strategy. The entry, stop loss, and target price is shown here. This trade can potentially give us a 1:3 risk-to-reward ratio, as indicated in the chart. Note that the target price cannot be blindly set to your risk-to-reward ratio. It's based on a number of technical parameters that we will cover in further sections. For instance, based on the analysis, you may discover that it's not highly probable to get more than 1.5R on a particular trade. In that case, you can just parse that on and wait for next opportunity if you are targeting minimum 2R return.